Yes.
Who would have to?
Yeah, so what if they drop dead? We won't miss them.
That's how they feel. The end
Yeah.
justify the means. If it save 80% of the lives and you lose 20%, they call it casualty of war, right?
So they call it, I'm
That's
sure.
how that's how they go.
I suspect if 50 million men were killed in World War II, more than all the wars of all the world combined from the beginning of time, and nobody's talking about that, I don't suppose nobody's going to give a damn about
That's true.
some
Believe you
person.
me.
Yeah.
That's it.
So they happen to be related to us. The hell with you and them.
Mhm.
I guess that's where we are right now. Interestingly enough. Fascinating.
This is the
Okay.
time we're living in.
Yes. Like my Grammy would say, I sorry for young people. Okay. My.
The world been here before, right? And it continued.
Absolutely. And it will be here until Christ returns. And as we all know, he will not come when we, or any plague decide to come. He's coming whenever he's good
That's right.
and ready.
That's something. These things are not really a predictor of us that what time he'll come.
No,
Because
only
100 years ago we went through the same thing.
2,000 years ago.
Yeah.
As a matter of fact,
True from beginning of time, yeah.
beginning, yeah, before
Diseases aren't new.
yeah, before Christ even came,
Mm-hmm.
when Pharaoh pissed God off, wouldn't lead the people.
Mm-hmm.
Oh, he says, okay, I'll send some plagues and save you.
And
And he was right there stenching with God, being biggity from then.
mhm.
So imagine, this is nothing new.
Nothing new under the sun.
No, but he's gonna let us catch eternal hell until he's ready. That's what it's always been. Because it's always our fault anyway,
Right.
doing nonsense. But in the meantime, we are asked to be encouraged and move forward. And that includes today's class. God forbid, lest we lose hope. And we cannot do that.
Yeah.
All right. Okay.
Mr. Wilkinson, I had a little challenge with one of the homework.
Which
That
one?
would have been page 483, question E10A with
Okay. Where did you get stuck?
where there was, let's see, distribution of loss.
Okay.
When one of the partners' capital was in a deficit.
Right.
And
Only one?
if I did it right,
Okay.
there was a deficit
Yeah,
after the
I
loss
had
was
that too.
distributed. After the
Right.
loss was distributed, there was a deficit.
After the loss?
Yeah,
Uh-huh. And then what?
I got stuck. I didn't know what to do with that loss.
Well, you shouldn't have a loss you shouldn't have anything left after a loss is distributed.
So that loss should have been distributed with those who had adequate amount of capital.
Well, it depends on what the agreement was in terms of how to distribute losses. How much was the total loss?
Well, I got 8,000 if I did it right.
Totally?
For one of the partners.
Okay, how many partners there were in total?
There were 3 partners. There was a $440 loss. And it was distributed among the partners. And one didn't have sufficient funds to cover his portion of the loss.
Only $440?
$440,000 was distributed among the partners.
Right. And
one of the
the 440,000 was loss or income?
Was lost.
Okay, the total amount was a net loss.
Right, yeah, it was a net loss on that.
Okay, divided between the partners.
Right, I divided among the partners. The partners ratio was 60-20-20.
Right.
Okay, the ones with one with 60% ratio and 20% was able to cover their loss with their capital. But there was one of the partners didn't have sufficient capital to cover their portion of the loss.
How much was that capital's capital? That
Their
partner,
at least the one that their initial capital was 80,000, and the loss they supposed to be covering was 88,000.
so you had 8,000, you had 8,000 hanging around,
Right.
and you want to know what to do with the 8,000.
Yes.
Well, if that's the only problem you have, then you're definitely on the right track. Natasha, what did you do with the 8,000?
Um, I have that as a deficit also,
Uh-huh.
but when when I distributed the cash, I gave it to her to zero it out.
When you distributed the cash.
Yeah,
So
My,
now we,
my, my initial thought was to just distribute the cash to the partners and let that loss offset his percentage. But I'm
well,
not sure, but because the loss, if there's a loss, the other partner is supposed to take care of it, right?
depends
no,
on,
the cash that was left, I have
Mm.
the negative 8,000 for the distribution of loss. But when the cash was distributed,
then, right?
I gave her the 8,000 and zeroed it out.
You follow that?
No, so for the distribution of income, of cash,
From the 200,000,
right, they would have gotten 20,000 normally, I guess. They would have gotten 20,000.
Well,
So would
how was the cash distributed? And by what percentage?
60, 20, 20.
Okay. So when you distribute the cash that way, how much did each partner get?
60,000, 20,000, and 20,000. So would the 8,000 be offset against their portion of the cash?
Well,
I wasn't sure of that.
if you offset the 8,000, what happens then?
They would get less,
And as they should, because they didn't have enough capital. Is that
right?
Natasha?
Yes.
I try to find the note why I did it like that.
I don't want to guess.
Because I was stuck, because I was thinking the cash had to be distributed based on the ratio. I'm trying to find the page.
But I think they were saying that the original partner is supposed to absorb the loss.
Now we're getting into
If the
another
cap,
question.
that's what I read, that if the one of the partners wasn't able to take care of his portion,
Uh-huh.
the other partner is supposed to absorb that loss.
Where did you see that?
I gotta find the page. Is it page 471, I think?
Okay, I saw it on 471, but on top of 470, it's saying, notice that the cash distributed to the partners is the balance in their respective capital accounts. Cash is not distributed according to the partner's stated ratio.
Aha. So that means then that at the end of the day, whatever cash is there, it should be automatically allocated. So we need to find out what to do with that 8,000. So we need to go to that note now and say, if one partner is not able to blah, 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 what do you do? What does the note say again?
Um,
Okay, in some
where the
liquidation,
loss is greater than the partner's capital balance.
Yeah. What does it say you do?
this
The
page,
partner must pay from their personal funds to cover the deficit.
Aha. And does it give any indication on how that is done?
at what point?
So,
I think that's what threw me. I think at what point is it done? Because it says in some liquidation, partner's share of the loss is greater than his or her capital.
yeah, so go ahead.
In such a situation, because partners are subject to unlimited liability, the partner must make up the deficit in his or her capital account from personal assets.
Which
So, so they need to take care of that loss prior to the distribution of the cash then.
yes. And so therefore that partner who has an $8,000 deficit, That
Mhm.
means whatever that capital is that caused it to go, it needs to be reduced by that amount with the assumption that they paid that off with their own what?
Cash.
Yes,
So they have to inject cash into the partnership for the $8,000
yes,
to bring their capital balance back to the initial amount.
back to what it should be before the $8,000 loss.
Okay, and then the distribution, the partners could be affected the right way.
It should work after that.
Okay, I read that.
Now, that's why it's what we call the fine print. See? Those little things, sometimes the things that make the difference between whether you get it through it or not. That same little point about if it's more what to do. So
Mhm.
be careful with that stuff when you're doing homework. Yeah, go hunting a little bit if you see something that is unusual, because the solution is sitting right in the fine print, so to speak. In your case, it's not fine print, it's right in the
It's book. I just wanted certainty.
ah,
You're
nothing,
reading it good.
nothing wrong with that. Way to go.
I didn't finalize that when I said, let me run this by you first.
Yeah, and I'm glad you did. You didn't wait or say the hell with it.
Okay, so we'll have to inject some cash back into the company to take care of that deficit and
Yeah.
then distribute the income, the cash.
Remaining cash.
Okay.
So, Mr. Wilkinson,
Hi.
would that be an extra explanation on the liquidation statement?
When you say an extra explanation, what do you mean?
Okay,
Could you say
'cause
something about it?
the first explanation would be the sale of the assets, then where we paid the liability, where we distributed the gain or loss,
Mhm.
and then I have where I distributed the cash. Would there be something between the distribution of the gain and loss and the distribution of the cash?
I think
Well,
so. We'll have to include that, eh?
that's a good question. Let me ask you this. Do
Mhm.
you have any examples in your text where they show that the partner uses personal funds and to pay it and we made a note on the liquidation statement?
No.
No. And so therefore the liquidation statement should not reflect it. You should just assume the partner had to pay it and take it back to where it should be.
Okay, that's why I put my 8,000 there to 0.
So, Mr. Wilkinson,
Yes.
okay. So if they were distributing 100,000 and he injected the 8,000 into the company, won't that become 108,000 cash?
No, well, not really.
No.
What happens is that that deficit that he's required to put in,
Mhm.
that is not necessarily at $8,000 that's going to go into the partner's capital account. So let's see, for example, after you account for the $8,000, let's say he pays it off, that 8,000. What is
Mhm.
now the capital balances after that?
It'll be 88, his initial amount, 88,000.
Okay, 88. And what's the amount for the other guys,
The other guys,
the other partners?
partners,
Capital.
one has 88 and I have one at 264 if I did it right.
264.
Mhm.
Yeah, I have the same thing.
Only two partners,
There's three.
and the other one.
Two at
88.
88,000 and one at 264,000.
Okay, and what is the total of all those three capital balances?
The total of all three capital balance,
440,000.
440,000.
that's the loss.
Mm-hmm.
Yeah, which is
Oh,
exact. Now is exactly equal to the 400,000.
40.
Okay, which is the loss.
Mm-hmm.
So that reflects the fact that the 8,000 was paid off by the partner, so that the loss, once we recalibrate the capital after the 8,000 is paid off, it's exactly equal to the loss. That's
Okay.
where that occurs. Now, what is the balance of cash that's left to be distributed?
200,000.
200,000.
Yes.
And how was that distributed to the partners?
Um,
How much did each partner get?
60, 40, 60, 20, 20.
10,000, 8,000, and 192,000.
for cash?
Yes,
Okay. So that was how much again? How much cash?
220, I mean, 200,000 total.
Okay, individually. How much did each
Um,
partner get?
Abby got, for what I have, Abby got 16,000,
Okay,
and I guess I gave Anna 8,000, and
Eight-
Anita had 192,000.
192,000. Does that equal 200,000?
Yes, sir.
Okay. You sure?
Okay, with Anna's 8,000,
Uh-huh.
I have that as a positive,
Okay.
and that's how I zeroed out, because with the distribution of loss, that
Mhm.
was a deficit. So when I shared out the cash, I put the 8,000 down as a positive.
Uh-huh. Now, let me ask you something. Is that 8,000 the same 8,000 that Tom Jones had to cover for the deficit?
That they would have been paying out of their personal fund.
Yes.
I would assume so.
Yeah,
Aha. Now, hold that thought. We have three partners, correct?
Mm-hmm.
One partner got 16,000 in cash. One partner got 8,000, is it?
Yes.
And then another partner got 192,000.
Mm-hmm.
Wouldn't that be more than
that's the
200?
balance on the capital account, right? That 16,801.92 would be the balance of the capital, their capital account after the distribution of losses.
Well, let's back up a little. We know that the losses have been distributed to 400,000. How much cash do we have available to distribute?
In total,
Yes,
okay, let me say 280 plus 280 plus 880. That's 640.
that's how much cash you have?
Yeah, their capital balances.
No, not capital balances.
Oh, you talking about the cash?
How much
Oh, the
cash do
cash,
you have to
the
distribute?
cash is 200,000.
Okay, so 200,000 is available to distribute. How was that distributed?
60%.
Of how
Which
much?
is 60% of 200,000 is 120.
120.
And the others would be at 120.
What percentage did the other partners get?
20% each. So both of them will get 40,000 each.
40,000. Okie dokie.
Okay.
Anybody have
got-
any question on that?
And you do nothing with the 8,000 because that was taken care of personally. There's no journal entry for that.
Correct. That
The
matter
cash
was,
injection.
that matter was resolved when it was taken care earlier, such
Mhm.
that once that was taken care of, then the deficit removed, then we were able to account for the full loss of $440,000.
Okay, and everything goes back to normal with the distribution of the cash.
Yes.
Okay, now that's clear.
Okay. Yeah, so that was a little curveball in there, which was good because
Yeah, so,
I got to actually go back to read something against it. Let me read that.
yeah. I refuse to submit the homework because of that. I'll submit it.
That's fine. You can submit it afterwards. No problem.
Well, I submitted it with my gas station.
Well, if you want to, you can resubmit. That's fine. My objective for the homework is exactly this: to
Mhm.
discuss where you had issues, resolve the issues, and then if you wish to resubmit, that's fine. Okay.
Okay.
My concern is that you actually understand stuff that gets you stuck. Okay, that's the point. Okay, so let's do the register. Hopefully everybody's here now. Natasha knows here. Andrika, are you there? Andrika. Andrika is off having a martini. Andrika, are you there? She'll come back and join us soon.
I'm sorry, I couldn't get into I had to unlock.
Okay, there you are.
But I could get it somehow.
Okay, perfect. Andrika, did you send homework number 1 to me?
Yes, I did. I
You
did
did.
reply.
Okay, I replied. Doggone it. Okay, just wanted to make sure I didn't miss you in that on my check. Okay, that's fine.
You want me to re-forward the email?
No, I have Andrika. That's you're fine, Andrika. Edrika. Yes. Edrika is off having coffee somewhere, I imagine. Hopefully she'll join us. I know Cheryl is here. Sure. And Jerry.
I'm here.
Excellent. The honeymooner. Whatever you say. Okay. Those of you who have not submitted homework yet, please go ahead. If you're still putting on finishing touches, you can go ahead and do that and send it to me. If you need until Saturday to finish up or tomorrow, please go ahead and do that and then send it to me. Because again, on Saturday, I'll be assigning homework for chapter 11, which will be due for Thursday of next week, so to speak, which will be a class review homework discussion session in preparation for your midterm exam that Saturday. Okay. I encourage you, even if your homework is off schedule, please complete it and send it in. It's important that you physically stress through it and do it. That's the key. It'll make you a stronger candidate in your examination next week, Saturday, than if you don't do the homework. Okay. There's no substitute for that kind of practice. Certainly not in accounting. Okay. Again, a reminder, your midterm is next week, Saturday from 9 to 12 at the Institute's classroom. So make sure you get ready for that one. On Thursday of next week, we'll have, again, a little mini review of any questions you would like for me to answer, any discussion on homework chapter 11, or any other of the chapters that we talked about, so that you can feel comfortable going into your examination. Any other questions at this point before we get started? Okay, so today we are going to talk about current liabilities and an accounting concept called fair value accounting. Now, I would like to assume that everybody in this class at this stage of your life hopefully knows what a liability is. Anybody not know what a liability is? That's wonderful. Who can tell me in simple language what a liability is? What is a liability? If you have a liability, what does that mean?
Something that is owed.
Yeah, an amount of money that is owed to someone or some entity. Okay? That is a liability. So if you owe anyone money, you have a liability in your life, and the sooner you can get rid of it, the better. People don't like you to hold on their money for too long. Most of us don't like persons to hold on to our money for too long, but that's the nature of a liability. Question for Jerry. Are you there, Jerry?
Yeah, ma'am.
This is a trivia question, liabilities question for you. Is Mrs. Jerry an asset or a liability?
An asset.
Ah, you You've learned how to answer correctly very early. That's good. All right. That's wonderful. Try as hell to keep it that way. That's the whole idea. What about children? Are children assets or liabilities? Anyone?
Both.
Are there a combination of both?
Depends on where they're at.
And what happens? Yeah, actually, they are hybrid in a strange kind of way, and it doesn't necessarily follow. Usually, the correct trend is that children are liabilities while we're looking after them, and they're supposed to become assets after they grow up and start looking after themselves, including the fact that maybe if you need their help, they'll help you. That doesn't always happen, but that's an expectation. So in that case, it starts off as a liability and then it ends up as an asset of some kind. On the other hand, we have the reverse that also happens. Some children start off as an asset, like they're little sweet little children. We love them, they're little cuties. They win the swim meet in primary school and track meet in high school, whatever. And then they grow up and do something crazy, like kidnap somebody's child, rape somebody, murder somebody, some crazy stuff. And then all of a sudden, our little asset that we love so dearly turns into a nightmare. And in some cases, a liability to us because we have to bail them out, stay up at night, can't sleep, crying, embarrassed, all these kinds of non-monetary liabilities. So yeah, remember I told you accounting is everywhere, even in our personal lives. But in business, and a liability represents an amount that is owed. Now, usually when we see an accounts payable, this means that we've made a purchase on credit. That's what accounts payable mean. Anytime you see the word payable, it means somebody owes money to somebody. That's what a payable is. And if you don't pay cash, then you're going to have a payable, you're going to owe somebody money, and they're going to expect you to pay off that payable as soon as possible. Now, whenever we make a purchase on credit, that means we get goods now, we pay later. But in some instances, we have payables that occur once a year as opposed to throughout the year. And when this happens, we say that these are what we call accruals in accounting. And you'll see somewhere between now and Saturday how accruals work in the accounting world. Very important concept. For some students, it's a nightmare until they get it. But once you get the concept, you begin to understand, this is great, I get it, this is important. Okay. Usually, when an accounts payable is involved for purchases, we have an invoice, the amount is known for sure, that must be paid. For accruals, however, it tends to be an estimate that we come up with, and you'll see how accountants do that later. The problem is in accounting, if we have accruals that we do not recognize or estimate and put into the accounting records, it will create some problems for the financial statement and that organization. It means then that certain transactions in the financial statements will not be recognized as being correct, and therefore the overall financial statements are going to be incorrect. Okay? Sometimes accruals are mismatched and done incorrectly on purpose because some organizations want the organization to look better than it actually is, to fool the shareholders, the government, and others, or simply just to show that the company's made greater profits so that they can get bigger bonuses in that particular year. And then the auditors come in and find out that the accruals were done incorrectly, they were manipulated so that things can look better than they actually are. So this thing about accruals is crucial. But we'll talk about that a little more later. For now, we're going to talk about the underlying concepts with regards to current liabilities and an interesting concept called fair market values. All right. I promised myself I wouldn't start with Natasha this time. I keep picking on her first since her name is at the top. So we'll start at the bottom with the honeymooners. Jerry, are you still there?
Yeah.
Does your text have that little write-up with the decision point with Maggie's Fitness Center, or do you have another write-up?
Let me see.
Or no write-up?
Um,
The very beginning.
it should be the page after the title page, right?
Yeah, it should be noted as decision point. Does 12 have any decision points at all? Do you see any decision points?
I think it's a different chapter in my text.
Oh, which edition are you looking at?
This is the 11th edition.
11E.
Yeah.
Okay, so for you, then that would be chapter 10.
Okay.
Yeah. Does,
Yeah. Maggie's Fitness Center. Okay.
yeah. Now hold that thought. Let me ask the other students. Do you guys have a decision point in your text?
I see something that says business insight on Teresa's Fitness Center.
Oh, Teresa Fitness Center. Okay, interesting. How does that begin for Teresa?
In January 2014, Teresa Matters started a business called Teresa's Fitness Center.
Okay, great. Stick a pin. Now that's
What
interesting.
page that is?
Yeah, what page is
That
that?
will be to the I guess 409,
Okay.
the
Now,
title page.
now Jerry's going to be reading from the other edition, but it's the same information. They just changed the name. So
Yeah.
don't panic.
Only the name is different.
Yeah, only the names have been changed to protect the innocent. I don't know. I guess they felt like, changing up a little. Okay, so only the names have changed. Everything else should be the same. All right, Jerry, let it rip.
In January 2009, Maggie Jones started a business called Maggie's Fitness Center. In addition to offering exercise classes, the center sells nutritional supplements. Maggie has limited experience in running a business, but she knows that it's extremely important for a company, especially a new company, to manage its liabilities so that it has enough cash on hand to pay debts when they come due, and that without a sufficient inflow of cash to do that, a company is likely to fail. Maggie is also well aware that incurring liabilities is a necessary part of doing business. When she started her business, Maggie signed over a promissory note to her bank for $16,000. To help operate the business, she hired two exercise instructors to whom she pays monthly salaries, and she has incurred debt in maintaining an inventory of nutritional supplements. Because she has not yet filed any tax reports for her business, other liabilities include taxes owed to both the federal and state governments, as well as the $3,600 in annual property taxes that the business owes to the city government. As the company is approaching the end of its second fiscal year, Maggie is anxious to figure out what the company currently owes the government and other parties and to assess its liquidity. After reading this chapter, you will know how Maggie should identify, compute, and report a company's current liabilities. You will also be familiar with the key measures used in evaluating liquidity.
Okay, stick a pin for a moment, Jerry. So you can see what I like about it is a simple illustration of the kinds of worries that business people have on a small scale. And if it's a multi-million billion dollar company, it's the same worries, it's just on a larger scale. Okay? So what we owe if we own a business is a very serious matter. And anybody who's in business who's not checking their liabilities constantly will find themselves thrown out of business. Most of us don't have all the cash we need, such that we don't have to go to the bank or ask some supply to give us a 30-day credit before we repay the invoice. Most of us have to borrow money from a bank, from to sellers in terms of invoicing, and also sometimes through other persons outside in the marketplace. The point is, whichever method we use, eventually we're going to incur some form of liability which has to be repaid. And as you can see right away, the amount of taxes and other liabilities that the company already owes And so she is anxious now because uh, on the right side of every liability is the word liquidity. Anybody knows what liquidity is? What does liquidity mean?
Um, is it how readily um, your assets can be converted into more liquid assets?
Like,
Cash?
absolutely. What is the most liquid asset?
Cash?
Absolutely. Anything other than cash, any other asset other than cash, is not as liquid as cash, obviously, maybe a little more liquid than long-term assets, obviously. But if it's not cash, even if it's receivables and people owe you money, you have to run them down to pay. You don't have any guarantee if they'll pay, when they'll pay, how much they'll pay. So that creates some liquidity, but not the kind of liquidity that cash produces. Okay. I have a client of mine who has this tendency to let receivables run out of the window, and then when it's time for him to pay bills, he has trouble paying his liabilities, including me, actually, because he's not keeping track of his cash flow. Those persons who are in his receivable accounts, he's not running them down to get the money. And if you don't know it yet, if people owe you money, very few people will come and volunteer to give it to you, even though they should. If you don't run them down, you don't get paid. Sometimes when you run them down, you don't get paid. Sometimes when you run them down, you only get paid some of the money. And so even an account as liquid as accounts receivable could present some problems with liquidity if you cannot convert the receivables into cash fast enough. Okay. So people owe you a bunch of money and you have to pay salaries, but the people who owe you money don't pay you that week. You may not be able to pay salaries, even except maybe you can go to your bank and say, hey, our receivables are not coming in on schedule. I need you to give me a temporary overdraft so I can pay my staff. Otherwise, they're going to riot and burn down the store. Okay. So that is designed so that you can get some insight into the importance of liabilities and liquidity within any type of business. Okay. So even if you decide to go in business for yourself one day, remember the discussion of liabilities is as important as any other concept, such as partnerships or long-term assets or receivables, or whatever the case might be, because anybody, any company that ignores its debt or its liabilities and its liquidity position will oftentimes find itself on the company gallows, meaning out of business. Okay. All right, so then, Jerry, let's keep going. Management issues that are related to current liabilities. Let's pick it up from there.
Um, Current liabilities require careful management of liquidity and cash flows, as well as close monitoring of accounts payable. In reporting on current liabilities, managers must understand how they should be reorganized, valued, classified, and disclosed. Continue.
Yeah, keep going.
Managing liquidity and cash flows. The primary reason a company incurs current liabilities is to meet its needs for cash during the operating cycle. As explained in Chapter 6, the operating cycle is the length of time it takes to purchase inventory, sell the inventory, and collect the resulting receivable. Most current liabilities arise in support of this cycle, as when accounts payable arise from purchases of inventory, accrued expenses arise from operating costs, and unearned revenues arise from customers' advance payments. Companies incur short-term debt to raise cash during periods of inventory buildup or while waiting for collection of receivables. They use the cash to pay the portion of long-term debt that is currently due and to pay liabilities arising from operations.
Okay, keep
Um,
going.
Failure to manage the cash flows related to current liabilities can have serious consequences. Um, for business. For instance, if suppliers are not paid on time, they may withhold shipments. I can hear her, but I can't hear what she's saying for some reason.
Somebody's talking?
I don't know if he was asking a question or not. I can't remember what she did.
Somebody
I
has a
have a
question?
question. I have,
Yes.
I have no idea what Jerry's reading. I'm in a different text and I don't know which page it's on, and I don't know if anyone else with 12 version is experiencing that. Because we should be to begin in a chapter, but I don't know where he is.
Oh, oh, your text is what you're saying.
On the first page, it defines current liabilities, and then there's some concepts: recognition, valuation, classification, disclosure. But Jerry's not reading that. So I think the text is different. I don't know if anyone else with 12 could like tell me which page we're on or tell me if I right.
Yeah, those
Yeah,
questions.
I was trying to follow, but I couldn't determine where he was in our text.
So this conversation in 11E does not have any kind of resemblance to 12E.
No,
None whatsoever.
Interesting. Does 12E use the Nike example?
It did with the fitness center in the beginning. It did.
it did help that, the fitness center, and then it went into concept underlining.
Yeah.
Okay. All right. Yeah, I suspect I didn't realize the differences. I mean, I did that. I was hoping you'd be able to find it without too many. You probably find it, but it doesn't necessarily line up in the same page, or sometimes the pages themselves even are different. Okay. So yeah, just hang in there and just kind of listen to Jerry for the moment. You'll find that when you get into your reading, if you haven't already, that it'll all tie in together anyway. All right, so let's just finish up on this, and then we'll get back to 12E.
I think it's page 433 and 12E edition.
That's what I'm thinking. It is there, just that they have them lined up in different places. Does everybody
Yeah.
see that? What page is it again, Natasha?
433.
Yeah, 433.
Okay.
So if while he's reading from that text, you kind of like, what the hell is that? That's perfectly okay. But it is sitting in there somewhere. They just don't have it lined up exactly the same for some reason, which is crazy. All right, keep going, Jerry. Where the
For
hell was
instance,
I? The failure.
yeah, failure to manage the cash flows related to current liabilities can have serious consequences for a business. For instance, if suppliers are not paid on time, they may withhold shipments that are vital to a company's operation. Continued failure to pay current liabilities can lead to bankruptcy. To evaluate a company's ability to pay its current liabilities, analysts often use two measures of liquidity: working capital and the current ratio, both of which we defined in an earlier chapter. Current liabilities are a key component of both these measures. They typically equal from 25 to 50% of total assets. As shown below, Nike's short-term liquidity as measured by working capital and the current ratio was positive in 2008 and improved somewhat in 2009.
Okay, stick a pin. Let's have a look at that. Now, if you notice, the current assets for Nike in 2009 are up slightly from 2008. Up always means something good is happening. Down usually suggests that there's a shrinkage somewhere and something was missed. But in this case, it's showing an increase year over year. And I'm just saying this so you can listen to the language of this crazy stuff. Okay, so that when you hear it later on, notice your text referred to the ratios from previous chapters. For those of us who did counting one, hopefully remember at least one of the many ratios that were discussed. But you'll see the relevant ratios again. That's the nature of accounting. It keeps overlapping. All right. So current assets year over year have increased, which is good. Current liabilities, by the way, has gone up or down. Anyone?
Down,
Down. Is that good or bad?
I would say good.
Yeah, that is good. Anytime your liabilities are going down, that is always a good sign. And in fact, A good sign of proper management of liabilities is to arrange a schedule wherever possible to reduce liabilities on a consistent basis if you cannot pay them off completely at one time. The ideal thing with a liability is to pay off everything as quickly as you can, but not all of us have the liquidity or cash to do that. So we have to pay X amount every month, every quarter, every 6 months, once a year, until we get our debt paid off. Okay? By the way, what is the amount of the current liabilities for 2008?
3,321 and 50 cents.
Okay, who agrees with that? He said 3,321 and 50 cents. Everybody agrees with that? No objections?
May not be in our book.
12 we has different figures.
Okay, what figures do you have for current liabilities in 2008?
You don't have 2008,
What, for
2010 and 2011.
okay, for 2010? How much is shown for
Current
2010?
liabilities, it says is that 3,364?
3,000,
364.
okay, great. I was hoping both of you would say that, so that let's back up a little bit in terms of these numbers, because sometimes they get a little tricky. If you notice in the paragraph just before the numbers, it says that as shown below in millions of dollars. So if those numbers are shown in millions of dollars, then we have to read them differently. Who can see that? Who knows what we mean by they have to read differently if the numbers are in millions of dollars?
Oh, the figure you see would be in millions.
You mean like 3 million?
It'll be $3,364,000.
Now, let me ask you a little question. Do you think that Nike's liability would be that little itsy amount?
No,
So that 3,364 should really read as what?
$3,364,000.
3 billion.
Okay. Oh, somebody said something else. 3 what?
Oh, 3 billion.
Million.
No, somebody said billion.
Yeah, 3 billion, 3,364 million, I think.
Absolutely.
That's
how
what it is? Oh,
That's what it means. So be careful. If you are sure, if it says in millions of dollars, then it means that the number.
okay, yeah, that's 3 billion. That's billion.
Yes. All right. So be careful with that. All right. What
Nice.
about, yeah, okay, little bits and pieces, just like that capital thing with that. How do you pay off the 8,000 deficit? It's stuck there in the details.
I
All
don't
right.
see that in details.
You mean the millions?
Mhm.
You may not see it in your text, but whenever you see the numbers where we have a number followed by, let's say in this case, 3 other numbers, usually that means it's in millions of dollars. But it should tell
Okay.
you, it should either tell you in the text, or it should have some inscription overhead that says millions of dollars or thousands of dollars. And so once you see that, you have to be careful how you read it, okay? Otherwise, you can end up putting the wrong thing. All right, that's just a little heads up. What about working capital, up or down? Year over year.
Working capital is down from 210 to 211.
Is that down?
Yeah.
Well, it was 210 in 2010.
In 210, the working capital was 7,595,000.
Okay.
And in 211, it was 7,339,000.
All right, so it went down by X amount of dollars. Okay, that's not too bad. And again, If you have not seen those ratios in a while, then you may not remember exactly how these are calculated, but that's fine for now. I just want you to see and feel the numbers. And of course, the current ratio, did it go up or down in your respective years, 210 and 211? Current ratio. Do you have a current ratio amount in your numbers?
It went down
From what to what?
from 3.26 to 2.85.
Yeah, absolutely. All right. Usually we don't want current ratios to go below 2. So it went down a bit, but it didn't go below 2. So we usually assume that that's an okay ratio. If you're not familiar with the ratios at this point, don't panic. I won't give you a ratio question that we do not discuss. Okay. Because ratios are actually dealt with in accounting 1. All right. So thank you very much, Jerry, for the moment. I'll be back. Okay, Cheryl, evaluating accounts payable. I don't know if that's your topic. Is that the topic you have next?
Yes.
Okay, let's pick it up from there.
Evaluating accounts payable. Another consideration in managing liquidity and cash flows is the time suppliers give a company to pay for purchases. Measurements commonly used to assess a company's ability to pay within a certain time frame are payables turnover and days payable.
Okay.
Payables turnover is the number of times on average that a company pays its accounts payable in an accounting period. This measure reflects the relative size of accounts payable, the credit terms offered by suppliers, and a company's diligence in paying its suppliers. To measure payables turnover from Nike, we must first calculate the purchases by adjusting the cost of goods sold for the change in inventory. By either an increase in inventory means purchases were more than the cost of goods sold.
Does that make sense, anyone? An increase in inventory usually means that purchases are more than cost of goods sold.
A decrease means purchases were less than cost of goods sold.
Everybody agrees with that? Does that make sense to anyone? What that means is simply this. Whenever you see cost of goods sold in accounting, that means that inventory has been sold. And the cost of goods simply means that it's been sold for X amount of money. That's all it means in accounting. It's not complicated. So usually if inventory is increasing, it means that we're purchasing more than we're actually selling. That's all that means. And usually, question? All right. And usually when there's a decrease in purchases, it means that when there's a decrease in cost of goods sold, it means that purchases are less than cost of goods sold. It's just the opposite. Okay. If it's not entirely clear yet, don't worry, it will become clearer eventually. All right, keep going.
Nike's cost of goods sold in 2011 was $20,862,000,000. And its inventory increased by $674 million. Using this data, we can compute Nike's payables turnover as follows in millions.
Okay, did they give a formula?
Yeah,
What formula did they give for payables turnover?
cost of goods sold, so plus minus the change in inventory, change in merchandise inventory over average accounts payable.
Okay, and did they give any number calculations?
Yes.
Okay, how did they set it up with the numbers? So that's the formula. Cost of goods sold plus or minus An increase or decrease
in change in merchandise inventory,
divided by
average accounts payable.
average accounts payable. All right, so how did they set up the numbers for that formula?
It will be the $20,862,000,
Mm-hmm.
which would be the inventory plus the $674 million in, I guess that's the inventory. No, the 20 million would be the cost of goods sold.
Okay.
The
Remember, you
600,
remember you
600
followed the formula, yes.
the 674 will be the change in inventory.
Plus or
Millions.
minus? Is it
Plus.
plus or minus? Plus,
Right.
okay.
Over average accounts payable,
Which
which
is,
will be the beginning plus the ending accounts payable divided by 2.
yes. Okay. And what answer do you get?
We have average accounts payable is 15.8 times.
And that gives you 15.8 times?
Yeah, that's what it gave.
Is that the textbook or our calculation?
That's the textbook.
Okay, so we believe the textbook. So the textbook says the average payables is 15 times. Based on our little reading just now, what do you think that 15 times means? Remember we said that the average payable is a measure of how many times we pay off our payables in full during the year. The accounting period is usually 1 year. So if we're paying off our payables like 15 times, is that good or bad, you think, during the year?
I think it's kind of bad.
Why do you think that?
Not too good. That's over a year, right? That'll take over a year to get right.
Remember, this is happening within 1 year. This is happening within 1 year. So if you're turning over your payables 15 times within 1 year, is that good or bad?
Should be good.
It's supposed to be good. Because it means that you're paying off roughly your payables in less than 30 days. If you're going to do it 15 times. So any supplier who's sending you goods are going to be happy to hear that. Because you get to pay, you have the money to pay off your debts faster, and the supplier gets paid sooner. In this case, it appears to be less than 30 days. The standard repayment time for traders is usually 30 days to 45 days. Okay, so that is beginning to look like a good thing. Okay, they get to pay off their debts fairly quickly. A lot of companies are so fortunate. Okay, all right, keep going.
As you can see, Nike's payables turnover is greater than the industry's illustrated. This indicates that Nike pays its suppliers very quickly.
Aha, did I say that? Yeah.
Yeah.
It means that they pay their suppliers very quickly because Nike has the money to do it, and the suppliers are very happy with Nike. They get paid sooner than anybody else in the industry, so they love doing business with Nike. That's what the days payable ratio calculation tells us. Okay, all right, keep going.
Days payable shows how long on average a company takes to pay its accounts payable. For Nike, it is computed as follows. Days payable equal 365 days divided by payables turnover.
I think Andriga wants to ask a question.
Andrika, yes. Hang on a second, Cheryl. Andrika, go ahead.
Previous formula, I'm wondering how we got the figures to calculate average accounts payable. And I see the 1,255 and 1,469. I don't know how we got one is beginning and one is ending, correct? I don't know how we got that, like, where do we see those figures?
Okay, can somebody interpret for me? Andrick is coming to my system like a little weird. What, can anybody hear a little clearer?
So
Yes, she's coming. Andrika, are you using a microphone or your computer?
I'm just using the device's microphone.
Okay, if you put your mouth a little closer, would that help? Because it's not coming through clearly, very clearly.
Is that better?
10,000 million. What did you do?
One moment.
Whatever you did, don't change that. You are clear as sin right now. Angelica's going to
Okay, hello?
perfect.
I was going through a little bit of technical difficulty. Sorry about that.
No
So
problem.
in the previous formula, when we were looking at average accounts payable, when we calculated that, we used two figures, and I have no idea where we got those figures from.
Which
So
figure
we use
is that?
1,255 and 1,469, and those were the beginning and ending. I don't even know. I have no idea what they are.
I'm so happy.
Inventory?
I'm so happy you raised it, because a lot of times students like see that, don't get in there, they don't say anything, and then like they never find out. Okay, so thank you for raising that question. Now the formula says that all that stuff is divided by average what? Do you see
Accounts payable.
average accounts payable? Now in accounting, Andrika, average balances are calculated like this. We take the beginning balance of whatever account it is, and we take the ending balance of whatever account it is, and then we divide it by 2. That's how we do average. Okay, so we're assuming that the numbers that were given in that formula, the first number is the beginning balance, and the second number is the ending balance, and then that is added together.
But the number wasn't actually given, is my question, because we could see the change in merchandise inventory, we could see the cost of goods sold, but I
Right.
don't see accounts payable figures.
So what are you showing for the denominator in the formula? The bottom part,
Well, I see it in the formula, but I mean, you know, that little thing we read beforehand
right?
that normally tells us information so that we can calculate it.
Right. Oh,
I don't see it there.
Yeah, because they didn't, quote unquote, put it there. And ideally, they should have put it there so you could see it. Okay. All they did was to put it into the formula, correct?
Correct.
Yeah. So sometimes they don't put it in the narrative, so to speak. Okay. They should have. And so that formula represents the information that should have been in the narrative. So your narrative should have read beginning payable balance X, ending payable balance Y, so that when you get to your formula, you can see that we add them together and divide it by 2 to come up with the average. Okay? Does that help?
That helps.
Yeah. So whenever you see average balances, even if it's not in the narrative, if it's not there, they should give it to you as a number, or in the narrative, they should provide you with the beginning and ending. And then once you have the beginning and ending, then you can work out your average, which is the beginning plus the ending divided by 2. Okay? So that's a good question, very important one, because that's how we do average balances in accounting, period. And that's how many companies do average balances outside of accounting, by taking two numbers, whatever those measures might be, and dividing them by 2. Okay, it's a very important concept to know. Good question. All right, so now so that's the payable side of things. So Nike pays quickly. It turns over 15 times. Average company tends to turn over like 3 or 4 times a year. Nike is 15 times. They have a lot of money. They pay their debts quickly, and everybody's happy with Nike. So now days payable, Cheryl says we take 365 days and divide it by what?
The payables turnover,
Which is?
15.8.
Which gives us a days payable of?
23.1 days.
Absolutely, which takes me back to my point when we were discussing payables ratio, and I said Nike pays quickly in less than 30 days. Okay, and in fact, when we do days payable, we can see they actually pay within 23 days.
Yeah, good. Do business with them.
Absolutely, one of the best in the industry, by the way. So folks who are sending invoices to Nike, they're always excited because they know they're going to get paid sooner than anybody else is going to pay them. Okay, so now you see the importance of those two ratios. Okay, one tells you how quickly inventory is turned over or paid, and the other one tells you the exact days that they're paid within. Both very important ratios. Okay? And any company who's not checking those ratios to see where they are is probably going to do so at their own peril. All right, keep going, Cheryl.
The next page.
What comes next? After the formula.
After the days payable, something to apply the solution.
Okay. And
Apply it. Jackie Coley Company has current assets of 30 million.
This is apply it.
Yes.
Okay, now you don't have to really apply it. What comes next?
Well, this is a tri-level problem.
Yeah, it goes to the question. So maybe we go back to the beginning,
of the book. Yeah.
Where we
This is
thought
at the
Jerry
end.
was, yeah.
Okay, interesting how they have it set up. Okay, which begins. Do you see payables turnover three whatever 15 point something? Did they explain what happened with Nike?
No.
Why?
It ends with the Nike's days payable is 23.1 days.
That's where it ends?
And
Yeah.
payables turnover is 15.8 times.
Just
Indicate that Nike pays
quickly.
Yeah.
So the next thing you're looking at are reporting liabilities.
Reporting.
No. Well, apparently we're all over the place. So.
Well, that has to be somewhere in your book because these liability reporting concepts, they are critical. They have to be somewhere in your.
Okay, it's in the book. It's in the book. It's just we have to
Are you
find
saying
it.
reporting or recording
Reporting.
with a P?
Yes.
Okay, well, I have recording.
You're recording?
Yes.
So you guys don't have like recognition and valuation and all that?
Yeah, yeah.
Recognition as the beginning. That's section 1 in our book.
Yeah, that's who we are.
That's the current concept underlying current liabilities.
Okay.
So start reading from there.
Yes.
Current liabilities are debts and obligations that a company expects to satisfy within 1 year or within its normal operating cycle, whichever is longer. They require not only careful management of liquidity and cash flows, but also close monitoring. Managers must understand how current liabilities should be recognized, valued, classified, and disclosed. Recognition. Timing is important in the recognition of liabilities. Failure to record a liability often goes along with failure to record an expense. The two errors lead to an understatement of expense and overstatement of income. Generally accepted accounting principles require that a liability be recorded when an obligation occurs, as when goods are bought on credit. However, some current liabilities are not the result of direct transactions. One reason for making adjusting entries is to recognize unreported liabilities and accrue during the period. Accrued liabilities include salaries payable, salaries payable and interest payable. Other liabilities that can only be estimated, such as tax payable, must also be recognized through adjusting entries.
Okay, so we're going to see them in a little bit, what these accrued liabilities are. Usually when salaries are accrued, it means that people have worked overtime, for example, but they haven't been paid yet. So that is a liability for the company. and it's a payable because it won't be paid until the next payday. And until the next payday, it has to be shown in the company's financial records as salaries payable. Same thing with interest payable. If you have an upcoming interest payment that is due in a month or 3 months, you have to accrue or calculate how much interest that will be and show it as a payable in your balance sheet until the time comes to pay that interest. If you do not do these things and make these adjustments, then your balance sheet will be incorrect. That's what we're saying. Some companies sometimes forget to accrue certain transactions, and therefore they either understate or overstate certain accounts, which, if you're talking about millions of dollars, can be a big problem. If you're talking about a few $100, it's not a big problem unless it's a small company, very small. But if you're talking about multi-millions of dollars being accruals not being done properly, you can easily see how financial statements can be made incorrect as a result. Okay, so keep your ears peeled. All right, keep going.
Agreements for future transactions do not have to be recognized. For instance, Microsoft may agree to pay an executive $250 million a
Million?
year,
Is that million?
$250 billion,
No.
250,000. We're not in millions anymore.
No. Yeah, you've been dealing with big numbers for so long. I said, man, that must be millions
Okay,
too.
the
I
executive
don't
agreed to
believe
pay
it.
$250,000 a year for a period of 3 years, or it might agree to buy an unspecified amount of advertising at a certain price over the next 5 years. Such contracts, though they are definite commitments, are not considered liabilities because they are for future, not past transactions. Because there is no current obligations, no liability is recognized. However, if the amounts involved are material, these commitments should be mentioned in the notes to the financial statement.
Now, bear in mind, folks, whether you run into this on job or elsewhere in conversation or whatever, in accounting, we do not record liabilities or anything else. We're dealing with liabilities, but we don't record anything else, including liabilities, until they happen. Does that make sense, everybody?
Yes.
We do not record liabilities or anything else based on speculation about what will happen in the future. So if they say that the executive will get 250,000, great. But nothing is recorded in the records until he actually what? Earns it. See my point? That's how accounting works. So don't let anybody come to you if you're doing like bookkeeping or accounting and saying, oh, we're gonna have an expense next week for $300,000. I'll put it in the books and I'll let you know when it actually occurs. If anybody comes to you with that, you said, fine, but I cannot accommodate you. What you need to do is let me know when it actually occurs, then I'll record it, because that's how accountants operate. We do not speculate, and we definitely do not record anything that has not yet happened. Okay? We call this historical accounting, meaning anything that we put in our records must have already occurred. I don't think I can make that any clearer. All right, but it's very important. Okay, keep going, Cheryl.
Valuations. On the balance sheet, a liability is generally valued at the amount of money needed to pay the debt or reported at the fair market value of the goods or services to be delivered. For most liabilities, at least one of these amounts is definitely known. For example, Amazon.com sells a large number of gift certificates that are redeemable in the future. The amount of the liability, unearned revenue, is known, but the exact timing is not known.
Let me ask you guys something for a moment. Why do you think we call this liability unearned interest? Sorry, revenue. Why do you think we call this unearned revenue? Or let me put it another way. Why is unearned revenue a liability? Same thing.
Because the services hasn't been rendered as yet.
Meaning you're on the right track. Meaning
Our,
The
our,
serv-
cus- our customer hasn't paid us yet, so I guess it's a liability.
now
The
when you
customer
say
could have paid,
when you
but
say you say pay,
Why would the customer have paid if we didn't do nothing yet, like give them any service?
some customers sometimes pay in advance.
now
That's true.
this is interesting. Notice what happens. Amazon.com sells a large number of gift certificates that are redeemable in the future. Now, that means that if Amazon sells them, did they get money?
They did.
They did. So they get the money up front and they're waiting for persons to bring the gift certificates in to what? Claim them. Correct?
Yes.
All right. Remember, if somebody gives you a gift certificate, you will go to John Bull and say, here's what I want for this gift certificate. It's valued at $300. All right. So that is the gift certificate that was sold in this case by Amazon. So when Amazon sells these gift certificates, it collects X amount of money in cash and it creates, so we debit cash for the money we collect and we credit a liability account called unearned revenue. And the reason why we credit the liability account is because Amazon has not yet honored those gift certificates, correct?
Yes.
And they will not honor them until when? People start
Till it's
coming,
presented, yeah.
yeah, until it's presented. Okay? Until it's presented. So until it's presented, that dollar value that they collected is a liability because they owe the whatever the gift certificates represent. They owe that to whoever's bringing it in. That's why we classify them as liabilities. Okay. Now, once the certificate comes in and the person redeems it, like, I want perfume for this. Now, what happens? Well, the liability for $300 is reduced by 300 with the redemption certificate, and then revenue goes from unearned to earned. Okay? But that's another transaction. The important thing I want you to know at this point is that whenever gift certificates are issued, it becomes a liability for the issuing company, obviously, because they owe whatever the gift certificates represent, and that'll be a liability until persons come in and start redeeming or collecting them. All right, keep going.
Some companies, however, must estimate future liabilities. For example, if an automobile dealer sells a car with a 1-year warranty on parts and service, the obligation is definite because the sale has occurred, but the amount of the obligations can only be estimated. Classification. As discussed earlier, current liabilities are due in the next year or within the normal operating cycle, whichever is longer, and are normally paid out of the current assets or with cash generated by operations. They contrast with long-term liabilities, which are liabilities due beyond 1 year or beyond the normal operating cycle. For example, Teresa Fitness Center may incur long-term liabilities to finance expansion to a larger location. The distinction between current and long-term liabilities affects the evaluation of a company's liquidity.
So what we're saying here is be careful, as you'll see it later on in the homework, that you understand clearly the difference between a current liability, which is usually liquidated within 1 year, and a long-term liability, which is usually extended beyond 1 year. 2 years, 3 years, 5 years, 50 years. Okay, that's the important difference in terms of classification. That's very important to know. All right, keep going.
Disclosure. In addition to reporting current liabilities in the balance sheet, a company may need to include additional explanation in the notes to its financial statements. For example, if a company's note payable account is large, it should disclose the balances, maturing dates, interest rates, and other feature of the debts in an explanatory note.
Mhm.
Eh.
Keep going.
Any special credit arrangement should also be disclosed. For example, in this note to its 2011 financial statement should also be disclosed. Okay, no. For example, in this note to its 2011 financial statement, Hershey Foods Corporation discloses the nature of its credit arrangements
Okay,
and short-term debts.
so they didn't show what the disclosure is.
I guess just the disclosure here, right?
Okay, let it rip.
Plus short-term debts. As a source of short-term financing, we enter into a new 5-year agreement establishing an unsecured revolving letter of credit to borrow up to $1.1 billion with an option to increase borrowing by an additional $400 million with the consent of the lenders.
Now, what is interesting here is, and this disclosure is designed so that the readers of the financial statements, such as shareholders who own the company, governments who are looking for taxes from the company, employees who work for the company, and anybody else who's interested, suppliers who supply goods and services to the company, they're all interested in this financial statements. These notes, these disclosures are very important because some companies, they just put a big fat number on the balance sheet and don't say anything about it because they don't want you to know anything about it. Because sometimes the information that comes behind it is not very favorable. And sometimes the company directors try to hide the information by not disclosing it at all. And if they are made to disclose it by auditors or others, they might put it in language that nobody understands or that is otherwise confusing for the average reader. None of which are acceptable, but very common practice. So this issue of disclosure on the financial statements is always a bone of contention. The directors of companies are oftentimes, especially if they're operating unethically, have a nasty tendency to either fail to disclose, period, on important information, or when they do, they don't give all the information. And when they're forced, they confuddle the information so that people are wondering by the time they finish reading it, what the hell it is in the first place. Okay? Just sort of put a little twist on that disclosure issue. It's just like even in our own personal relationships, if we want to hide something from our boss or our spouse or something, and they say, well, what are you doing? And what do we say? Nothing. Are you hiding something? No. Where are you going? Somewhere. With whom? Somebody. See, that kind of disclosure is not helpful to anyone. Okay. I can always tell, for example, when my wife is up to something sneaky, because she'll say, I'm going to get something. And I'm like, something has no name. I'm trying to get it to disclose fully. And she's like, yes, it has a name. Why? I said, just curious. And then she'll eventually say what it is. Now she's trying to get something to sneak into the house, like something like she shouldn't spend money for, or something she doesn't want me to see right away. Then she wouldn't disclose. She'll either say, I have to pick up something. And then I'm like, oh God, non-disclosure again. Should I ask her? And depending on what it is, I'm like what? See, like that. She says, Do I have to say what it is? I'm like, no, you don't have to. And so this is what the whole disclosure thing. But if you'd like to, that would be nice. And then it's like that. And then she'll finally say, well, it's a surprise or something. Oh, you'll see, or something like this. So this issue of non-disclosure or disclosure is very important for companies, especially when they're reporting in their financial statements. Now, I have a big thank you very much, Cheryl. You've been great dealing with all that crazy stuff. Do you guys have a stop and apply that shows the three ratios that we discussed: working capital, payables turnover, and days payable? You have that?
I think
Anywhere
that was
that
in the back of the book,
the back of the book or the back of the chapter?
back of the chapter, actually.
I see, to be careful with disclosure, because if you say the back of the book,
Back of the chapter. It
something
has been a long day.
I know. It's okay. So, do you have that stop and apply with those three ratios? What page is that on? Working capital, payables turnover, and days
That's
payable.
on page 435. Apply it.
Page 435, stop and apply. Any narrative in that?
Here it says Jackie's Cookie Company has
Yeah.
current assets of $30,000 and current liabilities of $20,000, of which accounts payables are $15,000. Jackie's cost of goods sold is $125,000. Its merchandise inventory increased by $5,000. The accounts payable were $11,000 the prior year. Calculate Jackie's working capital, payables turnover, and days payable.
Thank you, Cheryl. Now, let me say this. It is very possible that I will ask a question like this on the test, only because those three ratios are important from a liabilities perspective and a liquidity perspective. So, what does that mean you have to do? You have to,
Practice.
practice those formulas. Okay, they're not hard. I'm not going to give you a cheat sheet where you just put the numbers in without any sweat. That's not any real challenge. So you have to learn the formulas. The first one, for example, working capital, is the easiest of the three, a piece of cake. As you can see, the formula for working capital is current assets minus
Current liabilities.
liabilities. Simple as that. And all this data will be given to you. You will not have to guess. Okay? And so in this example, the working capital is $10,000. In other words, after paying off all its debt, the company still has how much in assets? After paying,
$30,000.
after paying off its debts, the company has how much in assets left?
10,000.
10,000.
$10,000. Does everybody see that?
Oh, my bad.
Absolutely. All right. And that's really what working capital measures. So you always want to have a positive working capital, right? If you have a negative working capital, let's say it was the other way around. Let's say your current assets were 20,000 and your debts were what? 30,000. Then you would have a what? Negative 10,000 or overdrawn account, wouldn't you?
Yeah.
Yes, your bank account would be overdrawn by
10,000.
$10,000. That's never good. Many companies have overdrafts though, in the hundreds of thousands and even millions. Some companies survive on overdraft. They never come out of overdraft. Every time they get money, they put some on, then they go back in overdraft again. Then they put some on and they get add to the overdraft. And some of them live in overdraft until the bank pulls the plug and say, you know what, 5 years of being in overdraft, you're not getting to anywhere near credit balance. We need to cut you off. We're not going to give any further overdraft facility, pay off what you owe, and then when your company's looking better, we'll consider a new overdraft facility. But that's another story. All right, so for working capital, we always want our current assets to equal more or to end up being more than our current liabilities. Formula number one. What is the formula for payables turnover, anyone?
That's cost of goods sold plus
Yeah.
or minus change in merchandise inventory divided by average accounts payable.
Okay, now here we go. So now we know what the cost of goods sold figure is. My question now is, why are we using plus 5,000 instead of minus 5,000?
Because it increased by 5,000.
Kiss my foot. Okay, so this stuff is beginning to sink in. Way to go. And notice the average accounts payable, we said, is based on beginning accounts payable plus ending accounts payable. Yeah. So where did the beginning accounts payable come from?
It just told us the account payable is 15,000, and then it's told us that the year prior it was 11,000.
Oh, so the year prior was 11,000. So the year prior, meaning the end of the previous year, becomes the beginning of the current year, correct?
Yes.
So we take that current or beginning balance, we add it to the 15 or ending balance, and we get $13,000. Divided by 2, get $13,000. Then it becomes easy. So the payables turnover is how many times?
10 times.
Better or worse than Nike?
They're worse than Nike, but like it ain't bad.
Who said that?
Andrico.
Way to go, Andrika. You're actually thinking about this crap. Long day or no long day. Absolutely. I'm always ecstatic when somebody says something like that because it means you're actually thinking about this crazy stuff. All right. Yeah. It's not as good as Nike, but not bad. 10 times is no slouch. 2 times is a problem, correct?
Mhm.
Yeah.
4 times might even be a problem depending on the industry you're in or not. All right. But 10, 15, 11, 12, 15 times, man, that's party time. Okay, and then finally, the formula for days payable is, I don't know, that looks like that's easier than the first one. It's the 365 days divided by
10.
10 times. So in this example, this ratio is telling us that the payables are paid every,
10 days.
uh-uh,
Every 36 and a half day.
yeah, every 36 and a half days, just over 1 month. Okay, all right, good stuff. So if I ask that in your midterm, there should be no flustered students. You just apply your formula and you'll be fine. And you actually even know what this crap means as well, which is equally as important as being able to calculate. All right. Thank you very much, Cheryl. Let's see who's on my hit list now. Edrika. Are you there? Edrika? Edrika. Okay. Andrika.
I'm here.
Okay, Andrika. Do you have a heading called definitely determinable liability?
I do.
Perfect. Why don't you let it rip from there?
Okay. Current liabilities that are set by contract or statute,
Uh-huh. Statute or law.
statute, and that can be measured exactly are called definitely determinable liabilities. The objectives in accounting for these liabilities are to determine their existence and amount, record them properly. The most common definitely determinable liabilities are described in the sections that follow.
Okay.
Accounts payable,
Keep going.
accounts payable. Accounts payable or trade accounts payable are short-term obligations to suppliers for goods or services. The amount in the accounts payable control account is supported by an accounts payable subsidiary ledger. This separate ledger contains an individual account for each person or company to whom money is owed.
Now, let me say this before you go on, Andrika. This accounts payable account represents all the money that your company owes to whomever. Now, the subsidiary accounts are sub-accounts with the name of each company that you owe money to. So if you owe money to 5 companies, you will have 5 subsidiary accounts. And when we add up all the balances you owe for each of the 5 accounts, that total will then go into your control account called accounts payable. And that is the account that will appear on your balance sheet. Does everybody get that?
Yes.
Okay, just wanted you to have a picture of that so you understand what it looks like in practice. All right, keep going.
Notes payable. Short-term notes payable are represented by promissory notes, which are written agreements to pay according to certain terms. A company may sign promissory notes to obtain bank loans, pay suppliers for goods and services, or secure credit from other sources. The interest rate is usually stated separately on the face of the note, as shown in Exhibit 1.
Okay, so this transaction is a simple note payable transaction. However, don't let all the little stuff scare you. It's pretty straightforward. First of all, do you guys have an example of the note itself that is signed by the customer?
Yes,
Okay, notice the note says blah, blah, blah. It's for how many days?
60 days,
60 days. And for what amount of money?
16,000.
Okay, 16,000. And of course, signed by the person who's borrowing the money. So once you sign that promissory note, that's what we mean by signing your life away. Now you are officially in debt. You owe someone, bank, person, company, whomever you owe. Once you sign that promissory note, then we make the journal entry for that loan that your company got. So what do we debit?
We debit cash,
For how much?
16,000,
Okay,
and we credit notes payable for 16,000.
okay. Simple as that. So we debit the money, the cash for the money we borrowed, and we credit notes payable because we now owe the financial institution or whoever gave us the money. What does the narrative say?
Borrowed 16,000 from bank and signed 60-day 3% promissory note.
Okay, should always have a narrative. And then once the journal entry is completed, the next step that we have to do is what? What's the next step that we have to do once the journal entry is done?
Post it.
Always. Remember the accounting cycle? If you ignore any step in the accounting cycle, something is going to get edged up. You must follow the steps in the cycle. Transaction, which is the signing of the promissory note, journal entry, which is the recording of the transaction, and now posting to maintain a record of the transactions. Okay, in that order, every single time. Okay, so if you look, we have an account called assets that we debit for 10,000, which is the cash you borrowed, and we have a liabilities account credited for $10,000, which is your payable account. And that's basically the way the transaction works for every loan your company gets. It's as simple as that. Okay. All right, keep going.
There's another
Any more
transaction.
journals? Okay, yeah. Before you go on, let's look at this other part of the transaction. So we sign the note, we journalize the transaction, we post it to the accounts. Now something else is happening, and that something else is this. It's time to pay the interest on the loan that you got. When is the interest payable? Can anybody tell?
When the note matures.
Which is when? Can you tell when the note matures?
Okay, we have the figure the date. It was a 60-day notes payable
Yeah.
issued January 1st.
I think it matures March 1st.
So March 1st, is it?
Yes.
Okay. How many months is that?
3 months.
3 months. Is it So you're looking at 90 days in your text.
No, that's 60 days.
No, we have 60 days, sorry, 2
Oh,
months.
60 days. All right, now we're on the same page. So this is a 60-day note. And what is the interest rate?
3%,
3%? That's what you guys have?
yeah.
Hmm, that's a good rate. The rate they gave us is 12%. That's a stinky rate like that. All right,
That's the more,
sorry?
realistic rate.
Agree. Absolutely. You're right on your game. That is a better rate by far. If we can get that kind of rate for any kind of borrowing, including
Not here.
hell no. You might get that somewhere in the United States or maybe Canada, but not here. Okay, these banks will drop dead and blowing up the building before they do even anything near that. All right. So, does anybody remember the formula for interest calculation?
Principal times the interest times the time.
Okay, that's fine. We usually call that interest rate, which is interest rate, by the way. So it's principal times interest rate times time. Now, what is the principal in this example?
16,000,
And the rate
3%,
and the time?
60 days,
So your interest for this particular note over 60 days will cost you how much?
$78.90.
Okay. Now that you calculate the interest, you can go ahead and prepare the journal entry showing that you paid not only the principal back, but the interest back in full. Okay. And how do we journalize that transaction? Very simple. First of all, we debit notes payable for,
16,000,
obviously, because now we're paying off the note. So if we credit notes payable when we got the note, we debit notes payable when we pay it off. Simple. What else do we debit?
interest expense,
Yeah, for the $78 that we owe, because that's the expense that you incurred for borrowing the money. And then what's the final part of this compound entry?
we credit cash,
For
$16,078.90.
both, yeah, for both the principal and interest amounts. Okay. So there you go, the whole 9 yards. Sign the promissory note, record the loan, post it, and prepare the journal entry and posting to show the loan is paid off in full. All right, keep going.
Bank loans and commercial paper. Although a company signs a promissory note for the full amount of the line of credit, it has great flexibility in using the available funds. It can increase its borrowing up to the limit when it needs cash and reduce the amount borrowed when it generates enough cash on its own. Both the amount borrowed and the interest rate charged by the bank may change daily. The bank may require the company to meet certain financial goals, such as maintaining specific profit margins, current ratios, or debt to equity ratios to retain its line of credit. Companies with excellent credit ratings can borrow short-term funds by issuing commercial paper. Commercial paper refers to the unsecured loans not backed by specific assets that are sold to the public, usually investment firms. Companies can quickly lose access to commercial paper if their credit ratings drop. Because of disappointing operating results in recent years, well-known companies like Chrysler, Lucent Technologies, and Motorola have lost some or all of their ability to issue commercial paper. The portion of a line of credit currently used and the amount of commercial paper issued are usually combined with notes payable in the current liabilities section of the balance sheet. Details
Okay. Go ahead.
Details are disclosed in a note to the financial statement.
Okay, so just for information, bank loan is also a payable. We just talked about it. When you borrow money from the bank, it's a note payable, you have to pay it back. Commercial paper is not from the bank. Commercial paper is usually issued by investment banks, special types of banks and other companies, large companies, on an unsecured basis to other companies who have good credit rating. And so they will issue commercial paper, which results in a loan to the other company for millions of dollars even, if they're satisfied that the company's credit rating is satisfactory, or even that their operating results are satisfactory. They will not issue commercial paper or commercial paper loan to a company who does not appear to be operating effectively, which is not profitable, and which may not have the ability to repay that commercial paper. Okay? In any event, both of these items, bank loans and commercial paper, are a form of lending. And if you borrow under use any of those two conditions, you will then have a liability, which you're expected to repay as agreed. All right. Okay. One more. So what's the next thing in your arsenal, Angelica?
Accrued liabilities.
Yes.
Okay. Accrued liabilities. As noted earlier, a key reason for making adjustment entries to a recognized liability is that are not already in the accounting records, is to recognize liabilities that are not already in the accounting records. Accrued liabilities or accrued expenses can include estimated liabilities. Interest payable, a definitely determinable liability, is an accrued liability. Interest accrues daily on interest-bearing notes. An adjusting entry is made at the end of each period to record the interest obligation up to that point. Transaction. The accounting period of Teresa's notes in Exhibit 1 ends on January 31 or 30 days after the issuance of a 60-day note.
Therefore, creating an adjustment that is required. Now, be careful with these accrued liabilities. In this example, we are told that we have a 60-day note, but in between the time that the person or the client got the note and the 60 days, we have a 30-day period when something happens. Something happens could be the end of the financial year, and therefore the 60 days is not yet passed, only 30 days is passed. So now we have to accrue for an additional 30 days or estimate. Okay, and this is where accrued liabilities come into play. All right, so let's see if we can figure out how that works. Now we are told that something happened and we had to calculate interest for 30 days. End of the year came up, or the end of the accounting period, since the note was signed. So only 30 days of the note has expired. There's another 30 days after the financial period ends. And the way we accrue for the 30 days is we take the principal. What is the principal in this example?
16,000.
Same 16 times the rate. Is it the same 3%?
Yes, sir.
Yeah, times 30 days. Now, why 30 days and not 60 days?
Because the period ended 30 days after the issuance of the note.
Indeed. So now we're only accruing, see? We're only accruing or counting for 30 days that has already passed. And so this is how we calculate the interest for the 30 days that has already passed, and at the same time, estimate for the 30 days that is to be paid in the next 30-day period, which is not yet come. This is how accruals work. So we account for the expense that has already occurred, and then that portion that is not yet occurred, which we refer to as a payable. So if you look at the journal entry, the 30 days that has already expired, which is what we calculated, we debit interest expense for the 9863, and we credit interest payable for 9863. Now, the reason why we do that, we're not going to actually pay the full interest for 60 days until the 60 days has passed. But because the accounting year has occurred, we have to account for the interest that was applicable just as at the end of the year, which is the 30 days. And because we have to show that expense in the accounts for the period that is just ended. And this note is showing that the period that has just ended includes 30 days of interest on this note. But it also includes another 30 days, which is coming in the new month, which will be paid in the new month. Okay? So this 98.63 is going to be paid when? 30 days into the new month. So what do you think the total interest is going to be at the end of the next 30 days?
Well, the total interest is 78.90.
Okay, and the interest for the current expense period will be
39.45.
39.45. And so what we're doing is we're recording the expense for the current period as interest expense, and we're crediting interest payable for that same amount, because even though we record the expense, we're not paying the interest yet. Does everybody get that?
Yes.
That's what we mean by accrued. An accrual is simply this. It's an amount that is due but not yet paid. Okay? So this amount that is due is 60 days, and this will not be paid until the end of the 60 days. That's why we call it an accrual. But in between comes the end of the accounting period, so we now have to show the 30 days that was expensed for the current accounting period. Okay? That's how we show accruals in our accounting records. Now, some students get this like really quick, and others have to do a little homework and a little extra, and then the bulb will go off. Boom. Now I get it. Okay. All right. Great. And then finally, Andrika, dividends payable, is that there too?
Yes.
Okay, keep going.
Cash dividends are a distribution of earnings to a corporation's stockholders, and a corporation's board of directors has the sole authority to declare them. The corporation has no liability for dividends until the date of declaration. During the brief time between that date and the date of payment, the dividends declared are considered current liabilities of the corporation.
Okay, keep going.
Sales and excise tax payable. Most states and many cities levy a
Mhm.
sales tax on retail transactions, and the federal government imposes the excise tax on some products such as gasoline. A merchant that sells goods subject to these taxes must collect the taxes, forward them, must collect the taxes and forward them periodically to the appropriate government agency. Until the merchant remits the amount it has collected to the government, the amount represents a current liability.
Hmm.
Transaction. On June 1, Teresa's Financial Center makes a $200 sale of nutritional supplements to a subject that is subject to a 5% sales tax and a 10% excise tax.
Okay, now, in case you haven't noticed it yet, this excise and sales tax thing is similar to VAT. Okay, we call it VAT, they call it sales tax, and by extension another tax called excise tax. And so, well, let me back up to the dividends payable liability before we get into the sales and excise tax payable. Dividends payable is an amount that is owed to persons who own shares in the company. Until the board of directors declare a dividend, the company has no liability. Once the board declares a dividend that we're going to pay 10 cents per share to our shareholders, once that declaration is made, it's the date of declaration, then the company has to establish a liability account. Okay? So what they will do is, if the dividends are going to be $3 million for the shareholders, they will debit a dividends expense because they have to pay this money out to the shareholders, and they will credit a liability account called dividends payable. And that dividends payable account will stay there for a week or 2 or 3 or 4 until the actual payment date of the dividend. Once the dividend is paid in cash to the shareholders, then the liability is extinguished, it disappears. But it doesn't disappear until it is actually paid. And until the dividend is actually paid, it is shown as a liability, just like the gift certificates. Until they are redeemed by persons who are holding those certificates, the company has a liability that it must meet and satisfy. Same thing with dividends. Once declared, must create a liability account, and that liability account will stay as an amount owing to shareholders until it's paid. Once it's paid, you debit the liability account, credit cash, and everybody is happy. Now, in the case of sales and excise taxes, similar to VAT, notice when we in the Bahamas collect VAT as a business, we are conducting what we call an agency duty for the government of the Bahamas. So what companies are doing is they're collecting the VAT from people for the government, and the companies are expected to pay that VAT every month or every quarter to the government that they collected from us. Same thing with the sales tax. When you go into a store and you pay sales and excise tax, that sales and excise tax is not the company's money. It's the government's money. That's why if they discover that you're not paying your taxes to the government you collected, they can go so far as to sue you and imprison you for fraud, trying to defraud the government of its revenue. So any company in the Bahamas who is not paying VAT that they collect to the government on a regular basis, in fact, is using the government money to help run their businesses, which is illegal. They are not required to do that because the money they collect in VAT taxes is not theirs to use, even though many of them use it and say, I'll pay it when I pay it. Okay. All right, so in this example, the actual cost of the sale is $200, but we're collecting $230. Does anybody know why? Well, if the sale is 200, why are we collecting 230? Are we robbing?
$10 was a sales tax and $20 was the excise tax.
Absolutely. Simple as that. So every time the company makes a sale, it debits cash for the cost of its item and whatever taxes it collected for the government. And then on the credit side, what does it do? It credits sale for the sale of its item, which is $200, and it credits two payable accounts because they owe the government. And that liability will sit there until they pay. Not a moment sooner will it be removed, okay? Or should be removed. All right, so that's how these payables work. Lots of little bits and pieces. All right, thank you very much, Andrika. That leaves, who's on my hit it? Natasha, finally we got to you again. You always first, now are you there, Natasha?
Yes, sir.
Okay, can you pick it up from there? The sale is properly?
The sale is properly recognized at $200 and the taxes collected, which are not revenues, are classified as liabilities to be remitted to the appropriate government agencies. Companies that have a physical presence in many cities and states require a complex accounting system for sales taxes because the rates vary from state to state and city to city. For internet companies, the sales tax situation is simpler. For example, Amazon.com is an internet company without a physical presence in most states. Thus, it does not always have to collect sales tax from its customers. This situation may change in the future, but so far, Congress has exempted most internet sales from sales
Okay,
tax.
stick a pin for a moment. Who agrees that internet companies should pay their share of sales tax? Should they be collecting sales tax, internet companies, if they don't have a physical building? What do you think?
No, because they don't have any overhead expenses.
That's an argument, which they might even try to use. But remember, the government is losing a lot of money because they are not making internet companies collect sales tax. Technically, it is unfair to ask a regular company on the ground, physical company, to collect sales taxes for the government on every sale they make, but not ask the internet companies to collect sales taxes for every sale they make. Okay? Because the question is, when you buy something online, you're not technically paying taxes. And the question is, how come? A sale is a sale, whether it's online or on the ground. Do you follow what I'm saying? Which is why there's the note that Congress might be changing that. One of the reasons why they may not have changed it at the time of this text that you have is that in the United States, for example, as in other countries, they have people we call lobbyists. Ever heard about them? Lobbyists. These are persons from these major companies, in this case, an internet company like Amazon, who will go to Congress in Washington and talk to senators and others and persuade them not to do it. Sometimes they even pay them or say that they'll give money to the campaign when elections are coming up or whatever else the hell they have to do in order to keep the government off their back. But not for long. Sooner or later, internet companies like Amazon will eventually have to start collecting sales tax. Because remember, Amazon does sales in the what? Hundreds, thousands, millions, or billions. Anyone?
So, Miss,
Billions.
Billions.
so Mr. Wilkinson, are the internet companies regulated? And how are they regulated?
They are regulated. The only problem is they are not required as at the date of this recent text to collect sales tax like other companies on the ground. And that's why
They're regulated.
yeah,
If they are regulated, there's no excuse for them not paying tax.
no, well, not collecting it. Correct. So see, what happens is, because remember, sometimes if they're not collecting sales tax, it gives the perception to customers that they're selling goods cheaper. So instead of going to the store on the ground, they go online anyway, for more than one reason, but that's one reason. All right. And companies on the ground are saying this is not fair. If we have to collect sales tax for the government on the ground, then those persons who are doing internet business should have to collect sales tax for the government there too. Makes sense. All right, Natasha, keep going. Current portion.
Current portion of long-term debt. The portion of long-term debt that is due within the next year and is to be paid from current assets is classified as a current liability. No journal entry is necessary when this is the case. The total debt is simply reclassified as a short-term and long-term when the company prepares its balance sheet and other financial statements. Payroll liabilities.
In other words,
In the,
sorry, Tasha, in other words, if you have a long-term mortgage, which is usually, or debt, which is usually 1 year or more, let's say it's a 5-year debt, that would be long-term. Anything longer than 1 year is long-term. Anything shorter than 1 year is short-term. So let's say your monthly payments on the long-term debt is $1,000. So for that full year, your annual total payments will be how much? If the monthly payments are $1,000. $12,000. Okay. So what we do in accounting is we say the annual payment for that long-term debt is $12,000. So we'll at the end of the financial year, we will take that annual amount and show that as a current liability on the balance sheet. And then the rest of the balance of the loan we show as a long-term liability under liabilities as well. So you have the 1 year portion shown as current liabilities and the rest of the debt still owing as a long-term liability. And I'm saying that in case you get a homework question, for example, that causes and forces you to have to know the difference between the two. Okay? You won't be stuck. All right, keep going.
payroll liabilities. In the banking and airline industries, payroll costs represent more than half of all operating costs. Payroll accounting is important because complex laws and significant liabilities are involved. The employer is liable to employees for wages and salaries and to various agencies for amounts withheld from wages and salaries and for related taxes. Wages are compensation of employees at an hourly rate. Salaries are compensation of employees at a monthly or yearly rate. Because payroll accounting applies only to an organization's employees, it is important to distinguish between employees and independent contractors as well as follows. An employee is paid a wage or salary by the organization and is under its direct supervision and control. An independent contractor offers services for a fee but is not under the organization's direct control or supervision. Certified public accountants, advertising agencies, and lawyers, for example, often act as independent contractors.
Okay,
Exhibit 2 shows how payroll liabilities relate to employee earnings and employer taxes and other costs. When accounting for payroll liabilities, it is important to keep the following in mind. The amount payable to employees is less than the amount of their earnings. This occurs because employers are required by law or are requested by employees to withhold certain amounts from wages and send them directly to government agencies or other organizations. An employer's total liabilities exceed employees' earnings because the employer must pay additional taxes and make other contributions, example for pensions and medical care, that increase the payroll costs and liabilities.
now the interesting thing about this, these are all agency duties that employers have to carry out. And they are, of course, they need accounting departments, et cetera, to do this. And so all these costs that are incurred by companies are somehow wrapped up in the cost of the goods that they sell to us. So sometimes when we go into a store and we see the price of an item, we say, this is bloody expensive. And oftentimes they are more expensive than they need to be, because some companies, they gouge you and they charge the highest possible price they can get away with, which is not always fair. But their idea is, since they have all these costs to cover, they want to be able to cover all their costs and still make a profit. Of course, ethics and the law and good business requires that we do, despite all of that, we still should seek to sell the product at a reasonable price. All right. That's the good thing about competition is if somebody's stuff is too high, we can go to the next place unless nobody else has it, then dog eat our lunch. Okay. All right, keep going.
The most common withholdings, taxes, and other payroll costs are described below. Federal income taxes. Employers are required to withhold federal income taxes from employees' paychecks and pay them to the U.S. Treasury. These taxes are collected each time an employee is paid.
Yes.
That
So
would be our NIB.
yeah, it's kind of like our NIB. Okay. For us, yes. My son works in New York, and so every time he gets his paycheck, he's like, "Ah, Dan, it's state and local taxes, Social Security taxes, by the time the medical care taxes, by the time they're taking out all those things, you're like hundreds of dollars in the hole each payday because of these deductions that come out of your salary, uh, and so on. But of course, at the end of the day, this is supposed to be able to cover your Medicare when you get old, your pension when you get like NIV pension when you get old, like stuff like this. So, that is supposed to make you feel better, and that's fine, except that sometimes it seems like it's not fair, the amount that they actually take out. All right, keep going.
State and local income taxes. Most states and some local governments levy income taxes. In most cases, the procedures for withholding are similar to those for federal income taxes.
Hmm?
Social Security FICA tax. The Social Security Program, the Federal Insurance Contribution Act, provides retirement and disability benefits and survivors benefits.
But sorry, this would be more like RNIB, okay? The
Okay.
Social Security tax. Mhm.
The 2012 security tax rate of 6.2% was paid by both employee and employer on the first 100 $110,100 earned by an employee during the calendar year. Both the rate and the base to which it applies are subject to change in future years.
Of course.
Medicare tax. A major extension of the Social Security program is Medicare, which provides hospitalization and medical insurance for persons over age 65. In 2012, the Medicare tax rate was 1.45% of gross income, with no limit, paid by both employee and employer.
Stick a pin. Um, we have something that we're trying to develop into a Medicare type of plan. Anybody knows what it's called?
NHI?
NHI, exactly. Our NHI obviously is just a few years old, so it doesn't provide all the goodies of a Medicare in the United States. But for a Medicare that it's just a few years old, new, it does offer some pretty good benefits for those of us who want to take advantage of them. At the moment, they don't deal with surgeries and cancer and all that stuff, and transplants and so on, but they do have a very extensive primary care program where you can get free blood tests, um, free doctor visits, and all this kind of stuff a couple times a year. So we've started our own little Medicare program. It has gotten stalled somewhere in terms of more offering more benefits. In other words, you don't get prescriptions free and all that. We still have to buy our own prescriptions. Unless you're a senior, you get a break under the prescription plan. But we NHI is our version of Medicare, and hopefully they'll get back to it soon to add some more and greater benefits. There is a discussion about taking something out of our salaries in order to cover Medicare or NHI. Everybody says, don't take anything out of my money, no, we don't now. Understandable. Well, what they should do is take more from those people who earn more and less from people who earn less. And those companies who do well, tax them the hell out of somewhere and get some of the money from them who do well. They're going to pass it on to us anyway in terms of the cost of the products they sell to us. But at least at the end of the day, we have more money in NHI, and maybe they can do more things for people when we get sick. And maybe one day we wouldn't have to have any more cookouts. I'll be dead by then, no doubt, but maybe you youngsters will be the beneficiaries of such a grandiose Medicare plan. All right, so if you look at, do you guys have this diagram showing how the taxes are allocated and paid? No? Okay, what a shame.
Would that be the total payroll cost we passed earlier?
Yeah, the total payroll cost in diagram form. You don't have it in diagram form.
Yes, that would be exhibit 2.
Yeah, that might be exhibit 2 where you have the take home pay, for example, and then you have all the other taxes that have to come out of the money, federal, state. Do you have that?
Yes.
Okay, great. So that's just kind of a diagrammatic picture of all the taxes. As you can see, they're very extensive and painful for persons. But on the other hand, there are some benefits to be had. Maybe they could take some more from the rich people as usual to remove the burden a little bit from the not so rich people, but that's another problem. All right, keep going. Medical.
Medical insurance. Many organizations provide medical benefits to employees. Often the employee contributes a portion of the cost through withholdings from income, and the employer pays the rest, usually a greater amount, to the insurance company.
Now, bear in mind that all these deductions we're talking about, once this money comes out of the salaries of employees in total, that money does not belong to the company. That is a liability for the company. They are not to spend it to do business, which many of them do sometimes. When I get the money back, I'll put it in, I'll pay. That's why so many companies have not paid national insurance. They collect money from employees, they use the money for the hell for something in the business or personal, and then they have thousands of dollars outstanding with NIB of unpaid monies that they already collected from employees, past and present. Okay, just a little bit of information there. It shouldn't work that way. Anything that comes out of the employee's salary that's deducted, it's a liability for the company. They have to pay it to the government. It is not the company's money. Okay? Anytime you have debt and you make money, you have to arrange to pay your bills. You can't say, thank God I get my whole salary for $2,000. I can buy what I want. You can't do that if you have bills to pay, especially if you have debt. If you have liabilities, you have to say, what are my liabilities? I need to pay them first. Once you pay your liabilities, then you can say, what do I have left? Then if you have enough to go to Andros and you feel like splurging, fine. Or Florida. But they say Florida is a hot spot. Don't go there at the moment. You might catch something. All right, keep going.
Pension contributions. Many organizations also provide pension benefits to employees. A portion of the pension contribution is withheld from the employee's income, and the organization pays the rest of the amount into the pension fund.
By the way, there was a huge company that was doing that, like many companies. They had gazillions of dollars, people's pensions that they collected in their own bank account over 20, 30, 40 years. And then the company went under and all the pension funds are lost. Okay? Because of mismanagement. First of all, the pension money that they collect from you as an employee should not be held with the company. It should be held in trust in a separate company where it is secure, so that if the company fails, you can get whatever you contributed up to that point. It should not be in the company's accounts. Otherwise, the company that you work for, otherwise they will be tempted, as many of them are, to use the money when they have what kind of problems? What's that L word?
Liability?
Liquidity. In other words, think about yourself. If you're holding an ASU and you have a liquidity problem, what might you do if you're not careful? Anyone? Somebody laugh. It's the same thing that companies do. They collect money from people's salary that is supposed to be paid to the government. They collect pension funds that's supposed to be secured for people's future. But when they start having liquidity problems, what do? They said, John, they call an emergency meeting. We have 20 million in pension fund. We need 15 million of that right now. Otherwise, we're going to go under. Let's take 15 million of the pension fund for this investment so we could save the company. And then when we get to make the money back, we'll put it back. Well, sometimes they make enough to put it back, and other times they
Don't.
Doggone playing Russian roulette with these deductions that they're taking from people's money. They're not supposed to do that. These pension funds and other deductions are liabilities, and they should be paid to the government as appropriate and held for the employees as appropriate. You're not supposed to touch it. But like the ASU money, if something comes up and you need $500 because something went down in the car or whatever, this is not my money, but I have to spend $500 out of this and I'll put it back. Some people are successful in putting it back, and then sometimes other things happen, you get to put it back, and then you're in trouble. Which means you should never have used it in the first place. All right, keep going.
Federal Unemployment Insurance, FUTA tax. This tax pays for programs for unemployed workers. It is paid only by employers and recently was 6.2% of the first 7,000 earned by each employee. This rate may vary from state to state. The employer is allowed a credit for unemployment taxes it pays to the state. The maximum credit is 5.4% of the first 7,000 earned by each employee. Most states set their rate at this maximum. Thus, the FUTA tax must often pay is 0.8%. 6.2% minus 5.4% of the taxable wages.
Question, do you have unemployment insurance in the Bahamas?
NIB unemployment benefit?
Yeah, that's the kind of unemployment insurance, which kicks in to the tune of some 40 or $50 million in the last year, okay? Because of the pandemic, they paid out at least $50 million, maybe more, in unscheduled unemployment benefits. Normally, it would be nowhere near that. Usually, if somebody loses their job, they pay you for a couple of months until you find a job, and then you go back to work until you're out of the job again. But of course, the pandemic lasted longer than everybody wanted to be, and so NIB was paying out for months and months and months. And as far as people are concerned, so what? Shut. That is our
Money.
Better be there when I need mine.
That's what I'm saying. I don't want to hear no horse there. That's way to go. Those of us who are older now, we don't want to hear no horse there who work for what, 30 and 40 years, right? You don't want to go when you turn 65 or 60 or whatever. Somebody has a long, sad story about how they had to pay it out during the pandemic, and therefore there's none for you at the moment.
An IOU note.
Yeah, they give you.
You can't take that to the store.
No. And so you have a whole bunch of old people rioting, blowing up NIB.
Well, that's
That's a serious.
That would be funny.
That would be serious after 40 years, because By that time, we're already 60, 65. We don't care anymore. We don't want to hear that the money went to COVID. Find some other money. We have already contributed our money and the employer's money for 40 years. Don't come to me with that nonsense. Just find it, or we're going to blow this place and anything else that comes in our way. And if you want to, lock us up because we're already old anyway. And without the pension, we may as well go to prison and eat off the state or something. All right, keep going.
State unemployment insurance tax. State unemployment programs provide compensation to eligible unemployed workers. The compensation is paid out of the fund provided by the 5.4% of the first 7,000 or the amount the state sets earned by each employee. In some states, employers with favorable employment records may be entitled to pay less than 5.4%. Recording payroll and related withholdings. On February 15th, Teresa's Fitness Center's wages for employees total $65,000 and withholdings for employees are as follows. $10,800 for federal income taxes, $2,400 for state income taxes, $4,030 for Social Security tax, $942 for Medicare tax, $1,800 for medical insurance, $2,600 for pension contributions.
All right. So now, I can see why my son in New York is complaining because every payday, this is the employer side, but these same taxes are deducted from employees every payday. A lower amount, of course, but several $100s potentially every payday. In the Bahamas, we don't have all that stuff yet. We pay VAT and other taxes indirectly, but the only direct tax we have on our income is what?
National insurance.
That's it. We have indirect taxes like VAT, etc. But if we don't want to pay VAT on bread, what do?
Make your bread.
Yeah, either make
You
bread.
still paying back though. You have to buy the supply,
Yeah.
the ingredients.
So
You can't circumvent that.
yes, you could stop eating bread.
Okay, okay, Mr. Wilkinson.
Yeah, stop.
You gotta eat something.
Yeah,
If bread don't get you, something else could get you.
that's true, but at least you wouldn't have to pay VAT on bread. So you save that money. So anything you don't have to eat, then don't buy. We pay a lot of VAT because we buy stuff that we don't really need to buy. Because Bahamians love to eat. So, that's why VAT is charged on all the Bahamian stuff that we love to eat. Because they know that no matter what pandemic,
You can buy it anyway.
food, definitely. We may not pay our bills or utilities or whatever, but we'll catch the jitney, but we're going to buy food come hell or high water. I mean, during the pandemic, when it was time to shop, regular working Bahamians, that trolley was filled up to the top.
Yeah.
And I'm like, man,
like we live to eat it.
yeah, we do.
We don't eat to live.
No, we live to eat. No question about it. Okay. So luckily for us, these taxes in the US and Canada and the UK are mandatory. They come out, all of them, each payday for those persons. My son just finally got some kind of ag job in Canada. Doesn't sound like he's coming home either. That's another issue. Anyway, I don't know the hell I got these doggone wonders from. But anyway, that's their choice. And they had the audacity to say, Dad, eventually you can come over. I'm like, really? They said, yes, Dad, you can come over and we can hang out. I'm like, okay. Sounds good. We'll see. But I love it home. But we'll see. But the thing is, he just got a little, and the first complaint he has is taxes as well, because the taxes in Canada are very high. People make fairly good salaries depending on where you work, but taxes are somewhere between 40 and up to 50% potentially
Of your income?
of your income.
Wow.
Of
They
course,
overflate.
of course,
They overflate your salary, take it back in.
something like that. But here's the benefit for that horrible thing. Education is free from primary preschool right up to university.
You know what you're paying for then?
Yeah, in that sense, yes. Healthcare, is free. Once you have a healthcare card, okay? If you don't have the card, you just rolled in and said, "Can I
And good healthcare.
Yeah, good healthcare is free. So those two key components are absolutely free, so to speak, in Canada. And so, yeah, you have some way of saying, okay, I'm still pissed, but I guess that's okay to some extent. See my point? Absolutely. All right. So in our transaction then, notice we debit wages expense for the full 65,000. And then individually, we record the payables for each deduction. Do you see that?
Yes.
So how much money actually goes to the employee eventually out of the 65,000? Can you tell from that entry?
Yeah, 42,428.
Absolutely. Where does the rest go?
Well, it goes to whatever.
Government. That's not complicated. Government. The only thing that
Well,
does,
it's not all government. Oh, government is
the only thing
medical.
that
Government
doesn't
is
go to
pension, all
government,
of that.
yeah, the only thing that doesn't go to government is the pension contributions that will go into the company's bank account and the pensions, or God forbid, or to a trust fund where it'll be safer. But other than that, everything else goes to government.
Oh,
Federal,
government taking
state,
care of you.
yeah.
You paying your keeps. No.
That's why over there, like they could do all kind of weird stuff and still seem to survive. And then you wonder, well, if they can do all that weird stuff and still seem to survive, why are so many people suffering hungry? I saw they had an ad the other day. If you get one, thing, what do you call the big Burger King thing? Not Junior Burger, the other one.
The Whopper.
Yeah, you get one Whopper for $5, you get another one free. And my question is, how the hell are people starving in the United States?
I
And
wonder
why?
why.
Okay, we could still buy 5 pounds of rice in the Bahamas for $2 or $3 and something cents, right?
No.
Yes.
You better. Well, we get up to do something.
I don't mean no Uncle Ben long grain rice. I mean Tingham rice.
I don't think any price for two something. I think three. Three
Yeah,
something.
okay, something, right? Let's say 3 pounds of rice or 5 pounds of rice, correct?
Must be 3 pounds.
Okay, but 3 pounds of rice can cook all kinds of rice until you faint and catch diabetes, correct?
Mm-hmm. That's all they
Yes.
will give you.
Yeah, no, if you put 2 cups of rice in the pot, it'll cook a full pot of rice.
Yes.
Just 2 cups now. So if you're paying $3 and something cents for 3 pounds of rice, then in the US is $1 and something.
Mm-hmm.
And then if you're paying like $5 for chicken wings and drumsticks and all that over there, it's for two something. And so 3 pounds of rice and $20 can buy you food to feed 4 people for a week. I'm just saying, if you're eating the bare minimum, how is it that people are starving to death?
I have no idea.
Neither do I. It's
Must be their deeds that follow them.
Oh, it's their fault. Yeah, they probably gambling it away. Like Behemoth said, we want money from NIB, and then as soon as they get the money, they run and give it to rich people, the gambling boys. How about that?
Mm-hmm. And come back broke again.
Dead break in Bohemianese.
Mhm.
Not only break, dead break in Bohemianese, okay? And then turn around and blame Dr. Menace for not giving them more.
Yeah.
Take to the guys so they can gamble it away again and not feed it. I hope that's not true, but I understand in many cases that is
Yeah,
true.
they say they gotta make 100. They have to make 500 out of that $100 they got.
Which only
That's an
happens,
investment to them.
but only a handful of people do that every couple of months.
Oh, unfortunately.
Yeah, gamblers never win. Only
No.
one or two. The only people who win in gambling are the people who own the gambling house.
Yep.
Whether it's a casino, a numbers house, or any other kind of gambling. They're designed for you to lose.
Well, the sooner they learn that, the better. But
Well, nobody's learned it yet because the gambling has been around since.
I guess enough people winning then.
Gambling, no. That's the same point. It's like being addicted to drugs. Because many people are addicted to drugs, does that make it good? No.
Make them feel good.
Well, that's what the Bible talks
People
about.
gotta do what makes them feel good for some reason.
Yes.
It pacify them, whether it's
and
good
those-
for you,
And most
it's
of the
one
things that make us feel good are destructive
destructive. That's the sad thing about it.
for us
It's,
and for everybody
Mhm.
around us,
Is it a
including,
delusion?
including our beloved children,
Delusional.
who we bring into this world and expose to our
Mhm.
garbage, and then
Mhm.
turn around and blame God even. Why did
That's
God,
right.
why did God allow this to happen to me? Okay, so that's kiss my foot. Accounting isn't everything. That's your journal entry for the payroll for a particular employer. Okay, keep going, Natasha. We're almost there.
Wages expense is recorded for the gross wages, but the various withholding are recognized as liabilities before net amount payable to employees is determined.
Okay,
Although,
keep going.
although the employees earn a total of 65,000, their take-home pay was only $42,428. On February 15th, Teresa records the fitness center's share of payroll taxes 50%, the health insurance premiums 80%, and the pension contributions 50%.
Now we have another journal entry, don't we?
Yes,
Now, what journal entry is this one? We saw the employees' deductions and the wages that were being paid. So what is this one?
It's the employers,
Oh, the
employer,
employer's responsibility now.
right?
Okay. So on the one hand, we have the employees' deductions and payroll and payables paid to the government, and then we have the employer's liabilities that has to be paid where? To the government as well. That's why employers get upset when you tell them that they have to hire more people than they want to hire. Because the more people are hired, the more what? Expensive it
Expenses.
becomes for them. And if they can't build that into their sales, then they have to accept it as loss and reduce profits. So they're always juggling, what sales price can I sell these things? I have to collect my money, all this cost that I have to cover. And if I cannot put in the sales price because of competition, I'll lose business. It's going to affect my bottom line. If it's going to affect my profits, how much can I continue to stay in business with that reduced profit? And it's a constant battle to maintain control costs and to keep sales going at its maximum. Okay. So being in business is a great thing if you can get things together, but it's a huge responsibility. All right. I think we'll stop there. You guys have been more than great, beyond fantastic, considering that you've been to work today and done all kinds of crazy stuff and a million other things to do. We will stop there on page 442. And when we come back on Saturday, we'll pick it up and finish the rest of the chapter. But before we go, are there any questions you'd like to raise at this point? If not, if anything comes up, you know what to do. Make a note of it. We'll talk about it on Saturday. Those of you who still have homework to pass in for chapter 10, send it in. If it's still chapter 10, anything for chapter 11, as soon as you're done, send it in. I won't assign homework for, sorry, chapter 12. I won't assign homework for chapter 11 until Saturday. Okay? All right.
okay.
So if that's good, you guys be safe out there. Understand that even if you have your vaccine, you still have to wear your mask. Dr. McMillan says she believes that some of the people who caught COVID, they've gotten it from people who were vaccinated, but still transmitted the disease because they figured since they were vaccinated that they can't pass it on to other people.
I don't get it.
So that's my point, Cheryl. The
These
whole thing,
vaccinations always a false sense of security.
always. Always. Okay, so we have our own Dr. Fauci's in NASA as well. We don't know
Mhm.
who to believe. All we know is take the vaccine or else. We'll
All
yeah,
I know, I see everybody is a potential having COVID, so wear my mask.
yeah. I would say until further notice, continue to wear your mask, continue to maintain your distance, continue to
That's
keep
it.
people out of your house who don't live there, who come to congregate, so they come to visit because they ain't seen you for a long time and all
That's,
that. We get
mhm.
that, but just know that after that little social setting, you don't know who's coming in your house. You don't know what they're bringing. You don't know where
That's
they're
right.
from. Even if they're related to you, if your mother doesn't live in the same house, she has to stay where she's living until, and vice versa, because she can bring it with cousin Ting and them, and so on. And then before you know it, you say, but this my mother. I gotta do it. Well, you gotta do it, maybe, but you're doing it at everybody's risk at the moment. Okay?
Mhm.
And even if your mom has to come to, let's say your mom lives in Andros and she has to come to visit, she could come to visit wearing her mask, keeping a distance. You do a little as close a hug as you could with and then she has to leave that same day. So you could wipe down and then so like that. Because the folks are moving around, you don't know what they are bringing. And then they leave to go out that day to do all kind of stuff, to visit other people. Like I just here for 2 days, I gotta visit everybody. Then they come back to you afternoon, and what are they bringing? You don't know. That's the nature of this problem.
That's it, eh?
Okay? And if you feel sentimental, that's okay. If you feel guilty because it's your mom, that's okay. But you still have to be rational. Tell your mom or dad you love them, but you have to stick to the protocols until.
Well, a word to the wise is sufficient.
Indeed. Okay. So you guys be safe out there. Take care. Remember COVID-19 and all the Alpha, Delta, Zeta, or whoever else is out there floating around. They do not discriminate and they know nothing about our personal relationships, correct? All right. Take care. I'll see you guys on Saturday, 9 o'clock.
Good night, all.
Good
Good night,
evening.
everybody. Good evening.
Good night.
Good evening.